You know, I was on the plane ride coming out here yesterday, and I was thinking about how long I've known Marty for. It's actually been 17 years. It was after I closed my first institutional fund, and pardon? Thank you. Thank you. Some of us, you know, have been through it, but it's interesting because I was thinking about like all the deals and everything that we've been able to come out of this, and we've made a lot of very successful investments coming out of this, and a lot of meaningful networks that have been pulled into this. And I'm going to give you a whole show and tell here and talk to you about everything that we've done together over the pandemic, and even our multi-family office structure. I'm going to show you everything we've done, how we balance it, and everything.
I just want to give you the share screen for
the share. Sure.
Okay, you're good.
Wonderful. So. My name is Buscemi. I have been operating with the moniker DAndrew Partners for the past 20 years. It's a nomenclative homage to my grandfather, who was a hotelier in the 1950s and 60s and worked with Staffler and all those guys. Real estate for me started out at Goldman Sachs. Since then, at 30, I raised my first, 29, I raised $30 million from a $750 million asset manager. For the purposes of just buying distressed debt. There's a whole loan that was coming off of their current balance sheet. We had a facility that we put together, that they put together, and we were able to give multiples back because we were buying these distressed whole loans from Bear Stearns and then selling them off by the shot to smaller investment groups. It worked out really well. And then I'm going to go into my background, but one of the things that I want to talk about here is how we look at the world, and there's going to be a theme here that you're going to see that really continues through when we do the fireside. HRN is the super secret multifamily office structure that we put together over the pandemic, and it was meant to be able to answer the family's needs for execution and what I call interactivity. To me, interactivity is the new currency with families today. They like interactivity. Remember, everybody has different blurbs that are coming at them, bite-sized pieces of anxiety, and we want to make sure that we're communicating and give a bunch of that attention to as well. Next slide. Yes, thank you. Great. So I'm going to go through the partner introduction a little bit. I'm going to slide in some things. If you really want to know what you know, how this all is put together, I have a book that I'm selling for you, so I won't let you down. Now, we're not selling investments. So let's go through the next slide. Partner introduction. I'm going to go through this. Some of you probably know that's me on the left. I started out my career at Goldman Sachs. I co-founded 2 separate distressed credit funds. I know distressed real estate very well. And since then, I have been an author, 3 times author. I just published my 3rd book. I'm also a contributor now on a monthly basis to Entrepreneur Magazine. Something that's not there is that I have a smaller balance, $5 million, mostly life sciences focused venture fund, and it is doing very, very well at an MOIC last year, around 4.36 after the pandemic. It's risen much more than that. If you give me your card, I'll send you the letter that I sent out. I sent out mine, has all my charisma. Great. William Workmister sits on the board for National Cancer Research. He has a tremendous background in venture capital. He started his first fund at 25 after leaving Solomon. He has 3 Ivy League degrees. He's very smart. And he is very, very good, and he's the reason why we have a very successful venture portfolio. Right. And then Albert Ewan just came over to us. He's a life sciences guy. He was formerly at Rockefeller right now. And he has a tremendous amount of experience, and he's really helping us put together finishing touches what relates to formulating sort of the branding of how this goes and how we communicate with the families out there. There's 2 types of families that there's 2 types of families out there, and I write about in the book. There's the established operating families, and then there's the emerging families. The emerging families are the ones who are liquid. They're the wealth creators. They don't know what's going on, so that's why they gravitate towards us. And that's mostly who I've been working with since my career. I remember going to get my first check at a family office, and the family office to me in 2003 was a townhome on 73rd Street Park in Madison, with a bunch of bankers' boxes, and they said, if you want the money, you got to figure out some stuff here first. Yeah, I don't know what I'm in. Tell me what I'm in. Can you value for me? Can you set up a data room? And then that's how we started working with families by building that trust. So HRE is formed because thank you. Because we had a lot of successes throughout real estate. With my background in life sciences, there was a commingling of families that trusted best-in-class kind of other families. If somebody's really good in real estate, somebody's really good in life sciences, there is going to be a carryover or mutual respect. And that's really what happens, that there's a community that's formed here which allows us to be able to work with these families so that they get into assets that they might not have been comfortable with in the first place. And that's brought us a lot of attention. I had, for example, a lot of real estate families who didn't know anything about life sciences or devices or anything, but we were able to invest in a company, headed by Fred Madden, for example. And good run, you know who that is, of course. And because of all that, all the families wanted to go together, so we had to come up with a structure that had to answer and solve for a few things. That's HR and value system. Okay, so we are not a fund. Let's click on the next one. We have a reputation for execution. We might not be the biggest investor, and a couple we are, but we move very fast. I'm going to show you a time trial. We're not broker dealers. I'm going to get into our structure with that a little later, but we trust. And this is what I tell everybody who comes to us. If they have to read my book first, Investing Legacy, then you understand the culture and what the expectations are. Because everybody has, you heard it before, and I was being harsh, has different egos and different identities that need to be answered for. And not all investors fit into the same box. We also wanted to make sure we had an alignment of interest, and that had to be proven in a model on this. Second, responsiveness and execution. We don't work with people who don't answer emails. You can't, if you're really serious about something, you gotta let us know. You gotta have the enthusiasm, because that enthusiasm is contagious. And then also the access too. Here's something that you haven't heard from anyone lately. We are completely event driven. We're event driven because we have a great reputation in this market. It's not like we're out there looking for deals. We do not have a fund structure. I don't have an IR clock to my head, as a lot of these funds would say. So we structured it so that it's very symmetric. The culture is important to us. People want to know how we staff it. I'm in Las Vegas, and when I moved out to Las Vegas, there was one problem. The institution that gave me money for the second fund said, if you want the money, you have to move to Las Vegas, because there was a servicing company. And back during the day, during the Great Depression, there were a lot of hard money funds in Irvine and through all out Southwest America who were imploding because they were making loans on basically property that was lizard and snake territory that wasn't worth much. We were able to pull a lot of that out, but we staffed it primarily for people from BYU, Brigham Young University in Provo. And they have an excellent finance program. They actually happen to like what we do, and this is Noah. And that's my partner, Bill Workers to the right. That's me in the middle, and that's Noah Bradford to the left. Noah Bradford just got, because of his work with us and two other family offices that are the Firth and Fred Madden, he was able to get a front office job at Morgan Stanley in the high-tech investment banking division. So now, these families see that we have an interactivity, we're helping them, so that brings a lot of community and a lot of goodwill. You can guess where a lot of our money comes from. Best in class entrepreneurs, we'll go through this quickly. Every one of these has a story, and you can go to the next slide. Perfect. Immunicom. Immunicom was our second foray into this. I'll just get into it quickly. We got into it at $5 million valuation. Recently, as a value inflection, about $400 million. We're very happy with this, but this is what we do when we communicate. We have our CEOs. I had a podcast. They go out, the families see it, they understand it, they can put it around. And these videos are meant to make the families and the investors look good, because they're going to be forwarded around to other people's due diligence, say, what do you think about it, whatever. But because of the structure, we were able to do this, move on this very, very quickly. It landed in our lab, and you can't always wait for things to come. So this is why a fund structure doesn't work. Next slide. Genius Biotechnology is another one in Boston. This is headed by Albert Slanet. All of these CEOs have one thing in common that you'll see, is that they're best-in-class operators who have had multiple exits under their belt. Multiple exits. We're not into first-time operators. This guy is not eating ramen. He already had a multi-billion-dollar exit with Bluebird Bio, okay? That's all I care about. I'm on the board. I just got invited to the board of advisors alongside Stephen Rockefeller and a few other people too. Actually, my ex-boss is Goldman Sachs. Next slide, please. Thank you. Speaking of which, we do a lot of videos. So people are saying to us, and I'm not going to go through this deal, but this gentleman here remembers me when I was a youngin' back at Goldman Sachs. And what happened was that I wanted to go out and talk to the families, and how do I prove to them that I'm not full of shit, right? And so what I actually did is I called up people and families who we worked with, and I actually paid a ton of money to have professional camera crews go in and give interviews and testimonials. And in turn, it really helped us getting the AUM from these families who are excited, because now they're part of a community, which is great. If you want to see any of this stuff, you can see me, just send me a your card. But we got into this one that is that we alongside we invested in the GT with this with Apollo Capital Management. That was really the first deal we did. Those are excellent with HR structure. Rent It is by a close friend of Marty and I. This is something that's in my fund that we seeded with a few cowboy families first. Later on, it's really come into its own. We live in a rentier society today, as you've heard on the real estate panel. People are renting everything. They're renting jewelry. And I didn't really know what Rent It was, or the whole renting thing, until I went to my college reunion. And there were a lot of women who didn't look appropriate in runway style dresses. And I asked a female friend what was going on, and she said they rented the runway. This is the same thing with jewelry, and it's done, and it's headed by a world-class management team, a close friend of mine named David Robb. David Robb he was the sixth partner at Carlyle, and he has really shot this to the point where it's splitting up different revenue streams. Because if you know anything about jewelry, it is very expensive to insure. My late brother worked at Tiffany, the principal, for 20 years. Over those 20 years, my mom would go back and forth to the company store and acquire stuff, or it happened to be some sort of a discount or something. To insure that is prohibitive. He was able to get Allianz recently to do this. Now it becomes more of an insurance business rather than the renting business. He's done a great job with this. Next one, please. We only look at statement assets when we talk about real estate. Class A, we work with families who have done this before. We have a rule when we allocate to any operator. We like working with families because they are very liquid. They're not liquid. They have much more liquidity than most operators. And, some of them may have to continue to go out and raise money. We have been working very successfully on one project in Las Vegas, which is 100% full Class A industrial, 166,000 square foot. It has credit tenants in there. These are credit tenants that got very defensive when the world stopped and everybody was asking those questions. There's a lot of political risk in real estate today. And thankfully, we didn't have any of that because all the industrial tenants were seen as being first responders or having a priority so that they had to be open. During the pandemic in Las Vegas, that was leased up to 98%. And we're very happy. We're doing something with the same family in Austin. They're putting 50% down. Why do I like these families? They've been through 2 real estate cycles. They put in a significant amount of down payment or equity. And 3, they have an audited track record. And this has been the recipe for success. Because there's a lot of sacred money that goes into these types of assets, and people don't really understand it. And you have to really explain it to them in a way where they understand it, and they can actually communicate with their family. I think that's something very important. Communication is right. That's like how many do we have time?
You got about 10 minutes.
Oh, good. Okay, we'll go to the next one. And Boston, and then also another thing. We have another thing too, where we work with Alan Snyder. You can set a clock to him. He is absolutely amazing with his fine art income fund, fine art lending. He is someone you can set a clock to for us. If there's a new family that comes in and we don't want to work with them at first in a long-term deal, we throw them into Alan's first to see if we work together well, because we have a year liquidity provision on that, and it's worked very well. Nobody's asked for anything back, so it's really, really good thing to send them names. Right? I'm going to just skip because I want to get to the juicy part. Is that okay? Here we are, HR and legal structure. So you can click on the next one. Multifamily offices. What did we have to solve for when we were building this during the pandemic? And this was a $200,000 research and development project sponsored by yours truly, provided by Perkins Cooley. And what we had to do is we had to have a modular structure where partners can come in and out. There were families who have relationships, so we had to do some sort of a clearinghouse, so that we had to have a structure where, say, Marty comes in and he's got a great deal, but he's also bringing capital. How would he be? How would that structure look? Would he be, involved into everything else, or is it standalone? Different asset classes. We're asset class agnostic, we saw before. Venture, that means co-GP investments I was talking about before. Fixed income, all real estate. Everything is private. We don't do anything public. We like to think of ourselves in the venture world. Private company arbitral jurors. And capital introduction. There's a lot of people who come to us and we couldn't take capital because we didn't have a structure to take that capital. We're not a broker dealer. We do not want to be a broker dealer. We want to be direct, and we make direct investments only. And we also want to have a provable symmetric fee structure. And that fee structure, in so many words, says that the guppies don't get to ride along for free with the whales across the full freight voyage during the duration of the investment. So we had to put that together, and that's specific for each unique deal. So this is what it is, and it's actually quite modular. It's a master LLC. It's a series, Nevada series LLC that we use. It has one EIN, and then each Each series underneath it is named and it can be used as a direct investment into a company or whatever. And it rolls up to one EIN. For us, it's speed because all we need to do is to run the documents through our general counsel so that we can set up the bank account, usually within 48 hours. We don't have to wait for an EIN. We don't have to do all sorts of things. This is really a very, very efficient structure. Because also when you're doing ventures, you know, there's going to be times where you're going to be reinvesting and there's going to be a step up in basis. How do you account for that? You set up another series. It's very easy. Each one has its own incentives. Each is very unique, and each can be shaped, you know, to how we want it to be, so that we can be much more nimble and agile. All right. And what is also which is interesting about it too, is that for the Austin deal, we've actually set up a separately managed account. And this morning I was talking to an investor about this because he's bringing in equity to the table. So this separately managed, this series LLC structure allows us to have a lot more flexibility and work with a lot more people, much more intimately, but it allows us to also be very direct and powerful when we need to move on something fast.
That's per deal or
per deal? Per deal. Per deal, yeah. Per deal or per step up in basis. So I wrote a book on this stuff because over the past 20 years or so, since leaving Goldman Sachs, when it was the partnership days, there's been a lot of people who have always been asking me questions, and they wanted to know for sure, what is a family office? What does it look like? And I wrote a book specifically to answer a lot of these questions. And you know, the cheap slap on it, if you will, is that it's table manners for legacies. And that's exactly what it is. It sort of gives the lay of the law as it relates to what you can expect and clothes you should wear. And it gets into different things. It really gets into the psychological aspect that unless you're really working with families, you never understand this. For example, Albert Ewing came to us from Rockefeller. There's a chapter in the book called What's the Difference Between a $300 million family and a $30 billion family? And that is the most thumbed to chapter digitally on Amazon. Because people see it, they're like, what's the difference? Because people want to see what the differences are. And they are manifold. They are manifold. And the principal difference, I'll tell you, is that a lot of these emerging families are still operationally focused in the businesses that created the wealth in the first place. They don't have the time or the dexterity, frankly, to move over and start an investment office. So they're always very flustered. Whereas the established operating families, they have already CIOs and guys like Augustus. Next slide, please. So the motivations behind this, and so we actually had a lot of fun with this. And my late brother, I'll tell you an interesting story. This is me being conversational. This is not a textbook. There's no math beyond the cover. And I wanted to make sure that it was intended for a women audience. Guys don't read financial books. I have a friend named Mel Robbins, who is a very popular author. And I happened to run into her in a recording studio. Do you know who she is? No, yeah, I mean, she's awesome. And she told me in so many words, you have to understand that women are 70% book buyers. So how do I prove that I'm not full of shit? You know, and I could have easily gone with a major publisher. I decided to go with a female-based publisher, and that made kind of a difference. So what we did was we actually put together the 5 legacy avatars, which are the different types of legacies that I profiled or worked with over the years. Not all of them look like Warren Buffett. Not all of them drink, you know, eat cheeseburgers and drink Diet Coke. But there's different types of psychologies and egos and motivations. For example, the mogul's not interested in real estate. The nonconformist is not interested in real estate. The provider's interested in real estate. And the documentarian might be interested in real estate and venture too. And again, it's all in the book if you go to investinglegacy.com/book.
About 5 minutes.
Yep, 5 minutes. It's got a lot of strong multimedia support. I've been on TV. My publisher got me put on as a permanent, or for a year at least. My second article was published last week. Contributing author to Entrepreneur has 80 million page views a month, so that's pretty impressive. And I've been on Ticker talking about stuff with Lori Land. I'm on CBS New York. So the book is actually really taking it off. And then our own, we call him my younger brother, Marco Soriano, actually just wrote a book after I wrote mine. So people who buy my book today will get a copy of Marco's too. So that's going to be the 2-for-1 that I'm going to offer. Marco doesn't know that yet, but I do. Don't worry about that. You go to the next one. I hope you go
Back?
Yeah, go back. So that's really it. This has been actually an interesting process throughout the pandemic, working with families, because I think what we had to solve for was that everything's going to be, I think, more interactive online today. If there's this COVID variant that's coming out, there's another one, that's already spooking certain municipalities and certain at the city and local levels. And I think that's going to continue to affect the way we transact and do business together. This was built around, this multifamily office was built to be able to execute efficiently and quickly during any sort of, if there's any sort of pandemic or any reasons why we need to go into some sort of shutdown. It's been a great experience. We've had great returns on this. I will be putting out investor letters. If you want to read it, like sarcasm, drop me a card. It's very, very entertaining, family safe. But we talk about a little bit more about the history, about the deals, and why we get into it, why we really like these companies, and how long we've known these companies for. So we are a community that I am very proud to be a part of, and I look forward to working with some of you guys too. Dr. John, I'm looking at you.
Fantastic, Sal, and you're going to be for people who buy today. You'll be
Yes.
signing.
So I had a few boxes that were shipped. I have 50 here. If you want to buy the book, I will sign the copies for you. You can get them signed here, or you can go and you can buy them by going online too as well. There is,
Keep on.
yeah, so I can autograph and sign them for you here. It's interesting, a lot of the names in the book is written and it talks about certain conventions and ideas and theses, but then I have the families who actually I've worked with give quotations. And if you know anything about working with families, getting them to do anything like that, you're better off getting in the street naked down Park Avenue because it's just hard. And there have been some families, and I write it in the book, that did not want to, because we talk about the media today and the gulf between these ultra high net worth individuals versus the media being as wide as the curvature of the earth. So it answers and addresses a lot of the things in a non-academic textbook way, but in a very culturally appropriate way, where this is the way of the world today. Not everybody looks the same, and especially if you're dealing with families, you're going to have to deal with other motivations behind. Is this a good investment? I'm reading this like a wine list. Is this a good investment because I don't know how to price risk? We hold their hands, but that's part of the process. It's the interaction. Yes, Rob.
So how do you manage corporate governance? In some cases, it sounds like you're more hands-on, but in some cases, it sounds like you're more passive.
What do you mean as far as
Board seats and you're getting involved in strategic planning for your portfolio investments.
Right now, that's not really. I mean, that is something that we're working on, but it's not. It hasn't been the function of it yet. It hasn't been something that we had to pay attention to. We haven't done anything to it. But the corporate governance of this will be the families that are coming on, and they're not coming on to govern. They're coming on because they're looking for the experience. They want to learn. They're not guys like you. These are guys that sold a technology company for $60 million, and they just want to follow along and see what happens. So that's what we're offering to families when they say, okay, yeah, governance is fine, but this is like, you're going to be seeing what we're doing here. And when you start to see how the sausage is made, that's really where the experiential aspect comes in, where these guys are looking for that hard-nosed experience. Not stories or allegories, like this is what's going on, and this is how we're dealing with it. I once had to give back $19 million. It cost me $2,300 in wire fees. And I just basically buried my ego because I was not going to get outbid for a triple net lease grocery center by a dentist who had, a line of credit. It wasn't his money. You see what I mean? So I had to tell the investors, why are you giving back the money? Because it's the right thing to do. And so that's really what, that's when you look at the people, and I know some of the people I'm with, John, and Workminster and those guys, they're very strong ethical guys. And they have a very strong reputation in business, and they're able to source a lot of things. There was a deal here that we did last week. We funded it in 5 days. And the reason is because of that structure, but because we have a good reputation. Simplicity Health. It is headed by Linda Chin and Dr. James Allison, who's a 2018 Nobel Prize winner for immuno-oncology. I had him on a slide on a podcast, and families loved it. So there's a lot of good things happening. And as we formulate that, we're allocating right now. But as the new year comes around, when we start putting the series together, and we start telling people if you want to join and come in, that's going to be part of the draw to it, which is, yes, there's governors who are going to learn all of that, but you're also going to be able to look over our shoulder. And it's not going to be everybody. Good question. Yes, John.
So you have this barbell approach to risk, right? I mean, you've got your own asset, real estate expertise from your background, which is analyzable and calculable. On the other hand, you have the medical life sciences process, which is far more technological,
Subjective.
So it's speculative in certain instances. How do you go about the due diligence necessary to be comfortable with life sciences?
That's a very good question. I'll tell you, it's the same way that we've discovered success, or I've always had success in real estate, is we're only working with operators who've done this before. The more exits you've had under the belt, the more I want to talk to you. That's the first step. So I want to see how many times you've done this before successfully. And by the time it comes to us, it usually is an impressive amount of time. But you have to remember, though, that these things are coming to us in a way where they're being dropped on us to quickly move. We were able to raise that $300,000 for Pricity because another family couldn't make it. And we were able to get in at a basis where there would be a 2x on our MOIC on, at that point, because another institution was coming in. So a lot of these investments are episodic, if that makes sense. And because we are not allocating money, we're actually calling the money from you to invest here, this is the structure, then we don't have to worry about that.
So you're relying on the experience.
No, well, we have
of individuals before you.
No, that's the pre-qualification. That's what I want to see first. It's the pre-qualification of the management team. We want a world-class management team that's had exits before. That's most, and when we look at that with Genius, our Arctic company, or Immunicom, Amir Jaffrey, who's the CEO, he has on his team the former CEO of, I can't remember, Cardinal Health. And he was at Cardinal Health doing acquisitions. So he has the other team's playbook. So just now the conversation is getting interesting. I don't care about the technical. I want to know the story about the guys first before we get down to it. And then Bill Workmeister takes care of it from there. And he also crowdsources a lot of that due diligence too, which we pay for, but through the Character Society and a few other things where we know people who are very good at this. And that's really where you get an unbiased answer sometimes. When you're not dealing with the sell side for a dealer or investment professional, when you have other people who are passionate about it, you go out and you're fishing for dirt on the CEO and CEO. That I don't want to waste time on anything. I need to know who these guys are first because all mistakes are human. And if you've had many exits under your belt before, chances are you can still pull rabbits out of your hat, right? As compared to the first-time operator, who, this could be a form of tuition, and that's not something. But also, one other question to that too, before it gets to us, a lot of name brand families have already invested in this, and they share their research with us. For example, in Genius, the Anheuser-Orkland family was the lead investor in that. So there's other smart people in pedigree there that I'm able to look at before it even gets to the point where I actually want to see what the science and the numbers look like. That's what everything comes at you at once, and then you just filter it down. But if you have a good filter and you're very strict on what you're qualifying into that filter, it makes it a lot easier. And that's work. Yes, question.
It sounds like your ability to move quickly, does that help you drive value when you negotiate?
Yeah.
Like you did, so.
Yeah, I mean, if you look at Apricity, if you look at Apricity, they have a term sheet that came in before we made the investment. Okay, we got a 2x on that 300,000. Just for writing the check. We did the same thing with Sing Life, the Shimano family office. Remember Michael? What was his name? Nice guy. He used to work at. I can't remember. Same thing with Sing Life. We were able to get it.
Alienate the other people to tranche?
No, because it's a different series. You didn't subscribe to the series, so you're not in it. If you're not in the series, it doesn't affect you. Simplistic. It's so easy. So easy. It really is. The symmetry, I just want to talk about the symmetry of fees. One of the most important things that people see today are 2 and 20. It's almost impossible economically to run a 2 and 20 fund today unless you have massive assets under management. We've been very successful making these smaller niche investments, between anywhere between $500,000 and $2 million. And one of the things that's very interesting when you start moving into this is that the faster you move on these smaller deals means a lot higher multiple on invested capital later on. We're going after the things that families have already invested into. Somebody dropped off, or somebody needs another $1 million, another $1 million to build out a team or something. That's where we're able to get the best. Yet they know that they're not. It's not like hard money lending. They also know that look, there's going to be a lot more required for this too. And one of the things we do is before we allocate into it, I want to know who the other families are in there, right? That's something no one does. Okay, I mean, if I'm investing in this, why are these people investing in it? Let's share due diligence, right? And that's really where you start to see a lot of stuff and the magic happen. Yeah, so I don't have to sit on capital. Oh, if you don't partake, it's not it. But getting back to the fee structure, we made it so that for real estate, for example, you get almost an extra 100 basis points if you put in over $1 million, the fee structure that would be unique. So it incentivizes the whales to put more into it, especially something like Austin. We have a very defensive capital structure where you have a family putting in 50% of the equity. So it makes it much more appealing when you do it. This way, you are increasing yield without having to take on any other risk. That's an alignment of interest. Nobody likes to talk about that. Everybody likes to talk about other ways to get, a higher interest rate. But when you start being maybe creative with the fees and start putting yourself in the shoes of your investors, it's amazing how much attention you grab that. And actually, the email I put out said I should probably receive a humanitarian award for the fee structure I put together. And people opened it because it made sense. And they were like, good, you did the brain damage. It makes sense. So, yeah, very cool. Any other questions?